And without much ado, let me pass on the stage to Hugh Montag from the Bureau of Labor Statistics, who will be today's moderator. Hugh?
Thank you. The topics for today's sessions are navigating by falling stars, monetary policy with fiscally driven natural rates, and greed, profits, inflation, and aggregate demand. I'd like to offer a special thanks to the organizers, Rafaela Schunle at Brandeis University and Dominic Smith at the Bureau of Labor Statistics. This webinar will be about 45 minutes and will contain 2 presentations with approximately 15 minutes each. At the end after the presentations, there will be 10 to 15 minutes for a Q&A. Attendees do not have the option to switch on their audio or video, but are invited to write comments or questions in the Q&A space. Attendees can, of course, post their questions during the presentations already and do not have to wait until the end. The moderator will then select questions to be answered in the Q&A portion of the webinar after the presentations. This webinar is also live streamed right now via the CBRA YouTube channel and is recorded and will be made available on the CBRA website, www.cbra.org, and the CBRA YouTube channel after the event. Finally, a disclaimer. Participation in a CBRA webinar does not constitute or imply an endorsement, recommendation, or favoring endorsement of the views, opinions, products, or services of the Central Bank Research Association or any other participating institution, individual, or entity. All views expressed during a CBRA or CBRA-hosted event are strictly those of the authors, discussants, and other participants, and not those of CBRA, the co-sponsoring institutions, or any other participating institution. Okay, and with that, our first presentation today is by Jesus Fernandez Villaverde, the Howard Merks Presidential Professor of Economics at the University of Pennsylvania. The presentation is Navigating by Falling Stars with Monetary Policy with Fiscally Driven Natural Rates, and is co-authored with Rodolfo Campos, Galo Nuno, and Peter Paz.
Okay, should I go ahead?
Mm-hmm.
Okay, thanks a lot. Someone needs to start. Do you want to continue? Okay. Hopefully this will work. Okay. Does everyone see my slides? Very good. Good. So I want to tell you a little bit about monetary policy with fiscally driven natural rates. And as he was mentioning, this is with Rodolfo and Peter at the Bank of Spain and with Galo Nuno, who is right now at Basel, at the Bank of International Settlements. So let's think about how inflation is determined in the long run in the standard representative agent neo-Keynesian model, and it's actually quite straightforward. You have a Taylor rule that the monetary authority follows that determines the nominal policy rate, like the federal funds rate in the US, to be equal to some target real interest rate, some target inflation, and then a term that responds of the deviations between inflation and the target of inflation. In addition to it, because the model is a general equilibrium model, we know that there is such a thing as the natural rate, which you can think about it as the interest rate that you will have in the deterministic steady state of the model in the very long run. And over there, what you are going to get is that this natural rate, which we often call R star, is just 1 over beta, the discount rate minus 1. So the job of the central banker, in some sense, is quite straightforward. You just pick the target for your real interest rate to be equal to R star. And if your response to the deviation of inflation is more than 1, the coefficient phi over here is more than 1, then you actually achieve your inflation target. So monetary policy is to a large extent quite boring in the standard representative agent neo-Keynesian framework. Well, things are a little bit more subtle if you are in a heterogeneous agent model. And the reason for that is that in the heterogeneous agent model, not only you are saving to do intertemporal substitution, which is what gives this relation over here, but you are also saving to do precautionary motives, to achieve some precautionary motives. And that basically means that the amount of debt out there is going to determine the interest rate R star at which the saving market clears. Well, That means that if there is a debt finance fiscal expansion, it can also be a fiscal contraction, but for today's purpose, let me just focus on expansion. That's going to change the R star at which the saving markets clear. And we can think about this as a natural rate shock. What the governments do change the natural rate, or what the fiscal authority, to be a little bit more precise, does change the natural rate. And that means that the central bank must adapt its monetary policy to the long-term fiscal stance. That is, the central bank needs to understand that R hat needs to be equal to a quantity that will determine by the amount of government debt out there. Now, what we highlight in the paper is that this is a new form of monetary fiscal interaction that is unrelated to the fiscal theory of the price level. Nothing that what I'm going to say today is against or in favor of the fiscal theory of the price level, because over there what we are discussing is the price level that you need to ensure that the budget constraint, the intertemporal budget constraint of the government is satisfied. Here we are not going to do anything like that. And in fact, we are going to impose monetary and fiscal rules that ensure that we are always in a situation where the intertemporal budget constraint of the government is satisfied. The point is much simpler. The point is the natural rate is not an exogenous factor like it happens in a representative agent environment. As soon as you have heterogeneity, the natural rate is an endogenous object, and you need to understand this and react accordingly. So a very quick preview of the findings, since I only have 11 minutes left. First, we show that there is a minimum level of debt compatible with inflation target. And the reason for that is if there is not enough debt in the economy, then the interest rate that can clear the saving markets is going to be below zero, which will push the economy to the zero, the real interest rate, which will push the economy to the zero lower bound in nominal rates. And then we are going to have the standard equilibrium with inflation in the long run. Second, if the monetary authority, the central bank, does not adapt its monetary policy to permanent fiscal changes, then what we are going to have is that the long-term inflation will be higher. And compared to a rank model, short-term dynamics are more inflationary, even if the central bank adjusts due to income effects, which perhaps today I'm not going to have time to explore in all their entirety, but which I encourage you to take a look in the paper. We also argue that monetary policy rules different from the standard Taylor rule, like the one that Orphanides and Williams have proposed for many years, perform much better in this environment because you don't need to depend on an estimate of the R star. So maybe instead of having a lot of seminars about what the R star of the economy is, what we can do is say, let's design a monetary policy that does not really depend on the R star. And then we are going to do a little bit of an empirical exercise, although I think that today that will only be a couple of slides where I show you some of the main results, where we can infer the policy gap between the central bank intercept R hat and the natural rate using market data. And we will argue that perhaps part of the problem that we had of high inflation during the last 3 years may have been driven by this policy gap. Now, I'm not, and we are very clear about it, we are not saying that this is the whole explanation of what happened over the last 3 years. Some of you may be aware, for instance, that I also have a paper that I really like a lot about how global supply chain shocks matter a lot, but we think nonetheless that this is part of the story. Okay, let me get very quickly into the model without further ado. In the interest of time, I'm going to go very quickly. We are just going to have heterogeneous households. There is going to be a mass with measure 1 of households subject to idiosyncratic labor productivity shocks. And then we are going to have a Neo-Keynesian block. Now, something interesting about the Neo-Keynesian model, when you have heterogeneity, it's much better to have sticky wages than to have sticky prices. There's quite a bit of things that work better in terms of how we feed the data. There are kind of ways also to feed the data well with sticky prices, but you need to do a little bit more work. But at the end of the day, it doesn't really matter that much for the point that we are going to try to make today, because at the end of the day, we are going to have a Phillips curve that is going to be in terms of wages, not in terms of prices, but it's really what is going to be driven the results that are going to be in our paper. And then we are going to have a monetary and fiscal policy where a central bank follows a Taylor rule and a treasury is going to follow a very simple fiscal rules. And firms, we are just going to have a representative firm with aggregate production function and flex prices. Again, I could have also sticky prices over there, but this may be important for some details of the numerical computations, but for the main theoretical point, and I think for 90% of the numerical results, it doesn't really matter. Again, let me not spend a lot of time going over all the details of the model. You have some households. The interesting thing is that all the variables in the household are going to be indexed both by their type of household and the shocks they have had and by time. So let me go directly to the fiscal policy of the Treasury, which is more interesting. And this is a treasury that can issue one period nominal bonds. Later in the paper, we are going to have an example where bonds or an extension where bonds can be issued with long maturity. And this actually is something quite interesting about that. But, the good thing about the one period is that it clarifies the issue much better, and that there is going to be a tax on wages. Remember, this is a model. We are going to do it without capital to simplify. So the only thing you can really tax are the wages. And what you're going to have is that the public debt is going to accumulate given the public debt that you have in the past, plus the primary deficit. And the government, this is the most important thing that you want to get out of this slide, follows a fiscal rule that has some jihad, which is the target of government consumption. And then there is going to have an adjustment term that is determined by the difference between the amount of public debt and the debt target. Now, this way of doing things is important because it ensures there is a long-run steady state, and it ensures that governments can pay down its public debt. Now, I know that some of you may say, look, I actually do not believe that the United States may be following a fiscal rule like this, or maybe some countries in the European Union may be following a fiscal rule like this, but that's not the point we are trying to make. The point we are trying to make is, even if the fiscal authority is keen on stabilizing the long-run level of debt, you are still going to get an interaction between fiscal and monetary policy. You see the point? So in some sense, this is not saying that this is the best description of the world. This is saying even if the fiscal authority is ensuring that, you are still going to have an interaction. And that's the type of situation, by the way, where the fiscal theory of the price level does not have much to say, because you have, this stability of the long run debt. Okay. And then you have a monetary policy where you have a central bank that follows a simple Taylor rule. The only interesting thing is that it's subject to the zero lower bound, and that's going to, do some work for us in a moment. Now, firms, there is nothing very interesting. Unions, they do whatever they need to do to have sticky wages, and then you have a standard market clearing conditions. So let me not spend much time on it. Now, then we calibrate the model. The calibration is absolutely a standard for the preferences, for the income process, for production. I really believe there is not a single parameter that anyone will have strong opinions about in terms of our choices. More interesting are the parameters of the fiscal policy. We are going to assume that there is going to be some debt target, that is going to be debt to GDP of 70%, that there is a government spending target, that there are some net transfers, that there is some reaction of the coefficient in the fiscal rule. And of course, our quantitative results will depend on these parameters. And what we try to argue in the paper is that we think that while we can discuss a little bit about concrete numbers, the big picture of what we want to say do not really depend much on these parameter values. Okay, so if you read the paper and you say, look, I would rather have a slightly different debt target, we are happy. We are happy to do that. We can perfectly do it. And this is just to illustrate the points we are after. Okay. So what is the point of the main argument of the paper? Well, as I was mentioning before, what you have in a model with heterogeneous agents is that heterogeneous agents save both to do intertemporal substitution and to do precautionary saving. There is also a little bit of precautionary saving in the model with a representative agent, but that is for standard calibrations absolutely minuscule, so we can forget about it. And in the same way that in the original Ajagari model, we can find that there is a demand for assets, that is this red curve over here, and there is going to be a supply for assets that is determined by the government debt. Now, we could have an extension of the model where there is also private capital, and that will imply that instead of having a vertical black line, what you will have is a black line that has a little bit of a slope. But the point in both cases will be the same, which is changes in the supply of debt are going to change the interest rate R star at which the markets clear. And that's going to matter because when we go back to the monetary policy, that will matter over there. In particular, what you are going to get is a formula like this one. It's kind of a first order approximation in the deterministic steady state of the model, where the inflation in the steady state will be the target, and then this term that depends on the difference between the natural rate and the rate that the central of the monetary authority sets as a target. That means that if we want to deliver on the inflation target, you need to make R star equal to R hat, or the other way around, you need to make R hat equal to R star. So changes in this black line will force you to make changes over here such that you can deliver on your target. As I was mentioning before, this has a number of implications. For instance, that if you have a very, very low level of inflation target, you really need quite a bit of bonds in the economy such that the interest rates that clear the market is sufficiently high. Otherwise, what you are going to have is there's a lot of demand for bonds. There is very little supply of bonds. That lowers the price. That increases the price of the bonds and hence lowers the interest rate, and that pushes you against the zero lower bound. And that kind of gives you an interesting point about why monetary policy actually does need some government debt out there. And then we do a number of exercises. And since I have very, very little time, the exercise that I'm going to report today is an exercise where the economy is at the steady state. And then there is a surprise increase of the target of government debt from 70% to 80%. It's an MIT shock, so completely unanticipated. And basically what you are going to have over there is that, for instance, here I'm going to compare rank with rank. There is going to be a change in the real interest rate that will induce that you need to have a change in the nominal interest rate in the long run. Otherwise, you will not deliver in terms of inflation. And in the paper, we discuss a lot about, exactly how the impulse response functions work, how the income effect happens, blah, 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 blah. But, I invite you to read the rest of the paper. The important thing is that we also do a little bit of empirical analysis at the end. We do a number of econometric exercises, and we actually find in the data using linear projections and using vector autoregressions that debt shocks, that is shocks that increase government consumption in the long run, have effects on the natural rate, on the R star, that seems to be very close in terms of size to what we find in the model, and hence that we conclude that this is important. Anyway, let me stop here because I already talked for 1 minute long.
Okay, thank you. Next up is Florin Bilby, professor of macroeconomics at the University of Cambridge. He will be presenting Greed, Profits, Inflation, and Aggregate Demand, which is co-authored with Diego Koenig.
Yes. Can you see the screen?
And before he starts, just a reminder, if you have any questions, you can type them into the Q&A box. Yes, we can see your screen.
Okay, let me hide the... Okay. So thank you to the organizers for the invitation and to those of you who are attending this. This is joint work with Diego, who is also among the panelists. So I'm sure he would be happy to answer your questions. So this is one of these papers where if you read the title, you can kind of already understand what we're doing, but let me try to go to it. So the one kind of quote that motivates this paper has been provided kindly by President Biden on the first year anniversary of the IRA, which was that he kind of makes a causal statement that says inflation went down because profits went down, implying that inflation had gone up because profits had gone up. And this is a point that you found in the press for about like 2 years, right? So these are just two examples from around here, the Economist and the Guardian that use the word causing profits, causing inflation, and then they use some artwork ranging from the poetic to more kind of mundane and cynical, that can imply that there's some people who are getting maybe a little bit too much out of whatever the economy was doing, booming or whatever, right? So the narrative again is one that you find in the press, but you find some notion of it also in policy speeches by some leading policymakers like Christine Lagarde and Isabel Schnabel, that says that there is something that links profits or the dynamics of profits to inflation, and this has been referred to as greed. And this greed, I mean, when you say greed, you have to talk about these distributional considerations, which say that there are some people who are again taking a little bit too much of the cake for their own benefit, and these are the people who get the profits. And this implicitly is going to hurt the ones who do not get the profits, who are maybe the poor, who are only getting labor income. And the key component of this is that this is all related to demand. Why? Because a key component of this greed narrative is that inflation was up not only because costs were going up and then firms increase their prices, it's just kind of optimization, but because firms, the story goes, were kind of taking advantage of the fact that demand was higher than usual in order to keep prices higher than otherwise they would have charged, right? So there is this inflation that's kind of beyond what was granted by the cost increase. So to narrow down the definition of greed that we are using in this paper, this consists of kind of two pillars or two planks. The first one is a very basic movement that is kind of a little bit difficult to get, although we know how to get it, between inflation, profits, and aggregate demand. All these things need to go up together. And then the second one, which is what distinguishes the so-called greed part of it, is that inflation needs to be unusually elevated through some sort of aggregate demand effect. So it has to be related to demand being very high. And this has to be related to distributional considerations that have to do with profits, because that's why we're saying the word greed and corporations' profits driving inflation. So to look at, like a kind of a photograph of the data of like the basic macroeconomic movements that you're trying to explain. So here what we're doing is we take a Hamilton filter of the basic macro time series, GDP, prices and profits, corporate profits, with some, the Cristiano Eichenbaum Evans way of doing it. And here what you see is this basic movement of profits going up quite a lot, and then inflation going up more than it did in previous business cycles. But you also see that demand was up. So there was no recession in the post-COVID, post-2021. So that's kind of the challenge for what we want to do here. So to go after this question, so we're trying to make sense of this using economic theory and using kind of heterogeneous agent, New Keynesian model. So you need a model with nominal rigidities and a model with both sticky prices and wages. And this is related to something that Jesus has said. So we're going to use that kind of model, but then within that model, we're going to kind of go into the heterogeneous agent direction, but keeping kind of both sticky prices and wages. So we're going to build on all this literature. So I'm going to talk in a second about how it's related to various papers. I'm not going to have time to go through the paper, but I want to give you it's like a trailer of the paper, but I think the whole story can be told by looking at this one equation. And this one equation is just our friend, the Phillips curve from the pricing decision, which is rewritten just slightly. So it's rewritten in a way that is useful for us to tell our story. In particular, I'm using a static version of the Phillips curve that I've been using for like 10 years to get analytics in a series of other papers, to some outrage initially, but I think now more and more people are kind of embracing this. So bear with me, forget about the expected inflation term here. So think about this inflation as being related to marginal cost. It's the usual Rothenberg, Calvo, whatever you want, or some extreme version of that. You can microfound it with the right assumption. So this is the slope of the Phillips curve, an index of price stickiness. When it's very low, prices are very sticky. When it's very, very high, then they go to flexible. But then the only thing we're doing here is to replace marginal cost by using the marginal cost equation and the profit definition, and the production function. And we're replacing this in here, and you can express inflation as a function of sales and profit. Okay, and what are these parameters? This alpha is the degree of returns to scale, so the curvature in the production function, and this calligraphic M is like in Gali's textbook, is a gross markup post-subsidy. So here is the key point of this paper. Take the standard New Keynesian model that has sticky prices only. In that model, especially in the case with constant returns to scale and efficient steady state, this term disappears. This coefficient is 0. So in fact, I have it on the next slide. So what you end up is with this. What is this? This says when there is, so this is all with demand shocks. We're not looking at all at supply shocks for a reason that I'm going to tell you in a second. So if you have a demand expansion, this says profits are counter-cyclical to demand shocks, and that's the thing that Jesus was hinting to earlier. So with sticky prices only, if you have an expansion in demand, this is going to increase labor demand, this is going to increase marginal cost, and that's going to make profits go down. But since the demand shock is a shock that increases both demand and prices, is going to be inflationary, you're going to have profits and inflation move in opposite directions. So there is no greed to be seen here. In fact, it's the opposite of greed. So in the standard model with just sticky prices, you're never going to get this. Now, if you add sticky wages, and we know this from, again, Cristiano Eichenbaum and Evans sort of numerically, that if you add sticky enough wages, then you can get sort of pro-cyclical profits, and then you may get some hope of this, you may think. However, if you look at this way of writing the Phillips curve, you're going to see that any demand shock that you have that's going to drive inflation up, consumption up, if profits are pro-cyclical, profits are also going to go up, they're going to still be deflationary. In other words, there is a direct effect, we call it, on profits that is deflationary, and that's always there, regardless of wages, prices being sticky, etc. What we're going to look at, and what we look at in this paper, is how can we get some sort of indirect effect that hopefully will go through distributional stuff, so through Hankish, Tankish stuff, that will amplify the response of aggregate demand. So because these profits go down, up, and blah, blah, what's going to happen to, can you get an expansion in aggregate demand that is high enough so that through indirect effects, you're going to get an increase in inflation that is larger than the usual business cycle increase in inflation. So that's what we're going to go after. And the answer is going to be, it's kind of hard to get. So the preliminary evidence that we look at, so what we did first is to say, well, we need profits to be pro-cyclical to demand shocks, and we know that from Cristiano Eichenbaum and Evans that they are, so they were the first to look at this in their seminal 2005 paper. So here I just selected the impulse response functions from their paper, and we redid the same estimation but with kind of state-of-the-art techniques. And you see that that co-movement is still there. In response to monetary expansion, you still have an expansion, inflation, and profit. So you need that procyclicality of profits, and that's hard to get with just sticky prices. Now, why do we focus on demand shocks? I mean, first of all, you saw that demand stayed up, so there is no, we really want to have the demand expansion. But there is a deeper reason, which is that if you tell me, oh no, but there were supply shocks, and again, like Jesus is like, I actually believe the story that a lot of the inflation that we have seen is due to supply shocks, but that's not greed, right? There's just costs going up, firms increasing their prices. That's not greed. So the question here is take that away, but why take that away? Take that away also because what that is gonna do to you is gonna give you also a recession. So you really want to have a demand expansion at the same time, because if you look at supply shocks, both theoretically and empirically, they're going to generate a negative correlation, first of all, between output and inflation. So they would give you a recession. So you need a demand expansion to explain why there hasn't been a recession. But also, if you look at the conditional moments, so here we're plotting the same sort of VAR evidence using these purge TFP shocks of Kirman and Sims, or the kind of Kentig oil price shocks. So we plot the effects of those, and you see that in response to those, you do get inflation, but you also get first the recession and the fall in profits. So it's not, if you want greed and you want elevated demand, you really need to look at demand shocks. So that's why you focus on demand shocks. So then let me tell you, I don't have the time to tell you how we get this. So we do three things here, right? So the first thing is to say, what is the analytical condition for you to be able to explain why profits, demand, and inflation all go up at the same time? So pro-cyclical profits in response to demand shocks. It's really just three equations, the definition of profits that we used earlier, the production function, and the Euler equation that just says the aggregate demand is driven by is controlled by the central bank, so that we can read the demand shock directly from the Phillips curve. And then we combine this with two static Phillips curves, like the ones we saw for prices. So we're going to have that for prices, and we're going to have the same for wages. So the kind of Herzeg, Henderson, Levine, but the static version of that. So these are all static equations, you plug them into each other, well, except for this one, which has an AR1 component, but you can solve in closed form for profits as a function of demand, and then state variables, like predetermined state variables. So you can read the cyclicality of profits directly from here. And in fact, when you go to the efficient steady state, when this markup is 1, then this big omega parameter, which is a composite parameter of the slope of the Phillips curve of prices, the slope of the Phillips curve of wages, that's going to give you the cyclicality of profit. So this is our first proposition. It's an analytical condition that says, when are profits pro-cyclical to demand shocks? When wages are sort of sticky enough. So enough in the sense made explicit by this analytical expression here. Again, this is, this was in the abstract of Cristiano Eichenbaum-Evans. So fundamentally, there is nothing kind of transcendental here. It's just something that can help you maybe discipline your quantitative models. And that will help us understand later on how we do this heterogeneous agent cases. So what is this? So what is the intuition here? I mean, first of all, there is one force there that whenever you have sticky prices, you have this deflationary effect of profits, or like the counter cyclicality in response to demand shocks. But then when you have sticky wages, you have inherently a force that gives you pro-cyclicality in response to demand shocks. Why? Because take the flexible price limit. In the flexible price limit, you're always going to be along the downward sloping labor demand curve. So then you're going to have costs and sales moving in opposite directions. So you're going to have pro-cyclical profits for free, right? So now if you put the two together, it depends which of the two forces dominates. So that's it. So this is just kind of a quantitative version of saying, for which slope of the wage Phillips curve versus price Phillips curve are you going to get pro-cyclical profits? And that's the yellow region here. Refreshingly, most of the estimates are kind of around here, so that's fine. But now let's go back to the Phillips curve that we looked at in the beginning, which tells you, well, but you have pro-cyclical profits, but remember that this doesn't mean that you're going to get large inflation. This just means that you're going to get pro-cyclical profits. So if you want to have a large increase in inflation, you need to somehow this increase in profits, it needs to be associated with a higher than usual demand expansion. So to get that, we go for the simplest model of heterogeneity that you can think of that had a mechanism that can give you that is, I guess, the tank model of my thesis of 20 years ago, in which you have two types of agents. You have hand-to-mouth agents and you have savers. And we use a sticky wage version of that is due to Ascari et al., which was an extension of this framework, Ascari, Colciago, and Rossi. And so that's a model in which you have some earnings. It's all log linearized here already. So the earnings, so you have hand-to-mouth agents that have a unit MPC. They have earnings and they may get some profits, maybe through fiscal redistribution, maybe because they're wealthy hand-to-mouth, maybe something else. But then you have the savers who have an Euler equation. So now if the central bank changes the interest rate, it's only going to change the intertemporal substitution of these guys. But if I want to look at the effect on aggregate demand, I need to aggregate this up and look at the fact that these agents aggregate to aggregate consumption. So one way to think of the aggregation of the aggregate dynamics of this model is to think of it in terms of consumption inequality, which is a sufficient statistic for telling you whether you have amplified or dampened effects on aggregate demand here. So you can get that by rewriting. So if you use the inequality of consumption, which is the difference between savers and hand-to-mouth, if you use that to rewrite the consumption of the savers as a sum of aggregate consumption, then something lambda, how many hand-to-mouth there are, times inequality. If you replace this in the aggregate, in the Euler equation of savers, you get the aggregated Euler equation, where you have the same Euler equation as you had in rank, but then you have this gap or this wedge that has to do with consumption inequality. So this tells you that when do you have a larger effect on aggregate demand than you get in the rank model? You have it when the inequality of consumption is counter-cyclical in response to demand shock. That is to say, whenever there is an expansion in aggregate demand, that is going to go more to the high MPC agents, to the low consumption high MPC agents, right? So
we're running to the end of the presentation time. So if you could kind of
so
bring things to a conclusion.
Yes, I'll do that in 1 minute. So this is gonna be problematic for this class of models. Why? Because now, if you think of this, this consumption inequality in the model that I've just shown you depends only on profits. So now, how would you get amplification here? You get it if consumption inequality is counter-cyclical, but that requires profits to be counter-cyclical, right? But we saw that we want profits to be pro-cyclical. So the conundrum here is that if you want pro-cyclical profits and you want them to go to the low MPC agents, who are the ones who hold assets, then you're going to get dampening, and that is the opposite of greed. So to explain high inflation in this class of models, you would actually need to get profit to take profits away. You will need lower profits. So that's kind of the opposite. The rest of the paper is going through two extensions that will give you a large enough increase in those indirect effects that are due to the first term. So those are, let me just give you the graph. So this is a model where you have both investment and counter-cyclical income risk. So these are things that are of the essence in a lot of the Hank literature. And in the paper, we discuss through what mechanism you get this increase in inflation that you see here relative to the rank model in this tank model, in this tractable heterogeneous agent model that has both inflation, both investment and counter-cyclical income risk. So again, like Jesus, I'm going to point you to the rest of the paper to understand it. Maybe we can have some discussion afterwards. So the conclusion is that it's kind of hard to get this from this class of models. Even when you get it with counter-cyclical risk, it is not because of profits, it is actually despite profits, because profits always work against inflation in this model. So if this turns out to be salient in the data, if we do the micro econometrics that will show us that no, but if you identify these profit margin shocks, they were inflationary, then we need to look at other theories and this kind of consumer anger of Rothenberg and others, and Pascal Michaillat's recent paper. Those would be sort of good ways of thinking about this. But we need to go outside this class of models. This will be the bottom line. Thank you, and sorry for going over time.
Okay. We're now in the Q&A. Let's see, our first question is for Fernandez Villavarde. This week we had and it comes from the audience, this week we had the finalization of the new EMU governance framework with a clear target on reducing public debt for member states in the EU. Do you think that these targets can work positively on the natural rate, reducing it and offering more space for the ECB to reduce rates? How should the ECB react with such rules, which actually coincide with the fiscal rules of long-term debt reduction you presented?
Okay, so let me be, well, first of all, thanks for the question. Let me be very, very clear. In the paper, we do not do welfare analysis. Okay, so we are not making statements about what is the optimal level of government debt and whether or not the European Union should impose those targets. Now, I have my personal beliefs about it, and we can talk about those later on if you want, but the paper doesn't undertake a normative analysis. What the paper clarifies is that if these rules are actually implemented, which is a big if, the European Central Bank will have to understand that with lower interest rate, with lower public debt, then there will also be a lower natural rate and hence adjust the monetary policy accordingly. Okay, the point we are trying to make over here is if I'm the governor of the European Central Bank, I need to look at public debt, and that's something very important in my discussion. Now, whether or not the European Union should lower or increase the target for debt is something that is beyond our paper. And as I was saying before, I'm happy to discuss it in another moment.
Okay, thank you. Next up is a question for Florin. What happens if shocks are large and wages and prices become more flexible, but are possibly differently persistent?
Yeah, so thanks. So I think this is very interesting. I've seen papers doing this. Mark Gertler has a paper about this kind of state-dependent pricing. I think you need to go to state, which Rafael knows well, to kind of the state-dependent pricing models and well, state-dependent wage setting models. Actually, if I cannot think of any off the top of my head. I'm sure there are several, but I think in a sense, maybe this is telling us we should be looking at that class of models. So yeah, it's not clear to me how this would play. So if you get more flexibility as the shock gets larger, I think it's an interesting question.
Okay. Next up is a question for Jesus. How much agent heterogeneity do you need? Is a two-agent model enough to generate your results? And then I guess the follow-up is, can you outline the conditions, if any, are needed that one needs to impose on the fiscal rule to get the main mechanism to work?
Okay.
I wanted to say I wasn't the one who asked the first question.
Okay. No, I somehow, as someone who does Bayesian econometrics, I'm keenly aware of the advantages of using priors. Yes, my suspicion is that yes, that with two agents, so for instance, one that has some high shock to income and another one with low shock to income, we will get these results. Then there is only a question of the extent to which quantitatively this matters. I don't have a particular strong opinion whether or not you want to have two agents or you want to have a continuum of agents. I tend to be very pragmatic. I thought that doing it with a continuum of agents illustrates perhaps a little bit better to the whole people in the Hank literature, which sounds to be popular now, the main point. But I really don't have a strong opinion about that. But yes, with two agents, you will get the result. The second question was, what do you need for the fiscal rule? You just need a fiscal rule where in the long run, the level of debt is different. Exactly how you deliver that doesn't really matter because the level of debt in the long run is what is going to determine the interest rate at which the savings market clears. So as long as the government can, let me be careful, the fiscal authority can affect through the supply of government debt that amount of government debt, then you get what you need. More in general, I could also have written a model with overlapping generations that will also deliver this situation, or a model where there is any other reason why Ricardian equivalence fails. And that will also deliver the thing. So in the paper, we try to be very open that we are just doing it within the within Hank framework, because it's, for good or for bad, it's what seems to be popular right now. And we are trying to make this point in the context that people find now more appealing. But this is a way more general point that Hank or overlapping or two models like the ones like the Tank models that Florin has done in many other contexts is a much more general point. As long as fiscal authorities can affect R star, the monetary authority needs to understand that. That's the main point of the paper.
Okay.
Thank you.
Next up is a question for Florin. How should we think of the role of financial frictions in affecting markups and profits for this question?
Diego, if I wanted to ask Diego if he had something to add, maybe to this or to the previous question first,
Okay.
Or I'm happy to reply also if not. Diego.
I mean, for the previous question, I just wanted to add, like, obviously, like if it's two large shocks, then you would have to go to different models. But like within our class, like, I mean, we try to go relatively flexible or like more or less so, and like it doesn't make like a huge difference quantitatively. And on the role of financial frictions, I mean, that's an interesting point. So that's like outside of the framework that we consider. So obviously this could possibly like affect, I guess, the cyclicality of markups, but that's something that we haven't looked at. And what we show is just that matters a lot when you look like through the lens more of the household side, but like looking at the interactions maybe between these more like supply side frictions and the household side, I think would be very interesting for future research, but that's something that we haven't looked at in detail yet. But maybe Florian, do you have anything to add on that?
Yeah, so I think it's, in a sense, I think also almost the bottom line of the paper is that we need to look outside this realm. So things like financial frictions. I assume by large shocks you meant, or whoever asked the question meant, large, so that the linear approximation, perturbation doesn't work. So you need to do global methods or something. So that's and that we did not look at. So it may well be that that's also interesting. So I think these are. But in a sense, it says, well, let's look elsewhere. Like if that turns out to be true in the data, then I actually had something to add to. Can I add something to Jesus, to the last question to Jesus? I find it super interesting, and I think so. If I understood correctly, one thing you do need and you don't get in a tank model. So I'm gonna kind of bash my past self, but while at the same time elevating the more recent stuff. I think you need a well-defined demand for precautionary saving that you don't get in a tank model.
Yep.
But you do get in the THANK model that we have at the very end, if you have liquidity. So if you have a government bond, then, and this I show in the recent Review of Economic Studies paper, that you have,
yes,
you can even solve for it analytically, and you have a demand. So then you can move along that curve. So it sounds like that's something that that's like the one ingredient you need for this work.
Yes, exactly. So, and let me give you, sorry to jump in as well. So I have this paper with Robert Barro and Oren Levinthal in Economic Journal about safe assets. Over there, we have only two types of agents, high risk aversion and low risk aversion. Over there, you will have the same result. So I will say it's kind of funny that you seem to be attacking tank and I seem to be defending them, but that's okay. That's, I guess, what science is supposed to be about. But I can deliver a lot of these results in a tank model.
Okay.
Okay. I have a question for Jesus. In the model, it seems like the government is supplying the debt and households are demanding it because of precautionary savings reasons. I was curious what would happen if households were either allowed to issue debt or if you had capital that's financed by firms, so that there's other assets that the households can purchase beyond government debt.
Okay, thank you. That's a great question. We actually have a subsection in the paper where we discuss it, so I invite you to read that part. Basically, what will happen over there is that remember I have this black line that was the supply of bonds, then that line will have a slope. And nonetheless, the government will still be able to move the slope there to the left or to the right with government debt. So it's an issue then, it's basically a quantitative issue. It's how much of extra government debt you need to clear the market given the amount of private financial assets and private capital. Kind of the reason we shut down, so we actually, the four co-authors, we had a long conversation about this, whether or not to have private assets. We decided to shut it down because we felt it was more confusing than clarifying. It was like another extra term. To be 100% on the disclosure, I was on the minority. I actually thought that with financial assets, private financial assets, this will be a little bit more compelling, but my three co-authors outvoted me and they thought that so this is one of those situations where maybe the conclusion should have like conclusion of co-author 1 and conclusion of co-authors 2 to 4. But the point is, at the end of the day, you get the same result, because coming back to the point I was telling to Florin, the only thing that you need is to break down Ricardian equivalence, and in complete markets, break down Ricardian equivalence.
We're running out of time. We have one last question. Hopefully we can get through it quick. This is for Florin. What was your greatest contribution to the literature on this subject? What would you suggest to future workers on this topic?
My greatest contribution, I think, is to use pencil and paper to get things. No, but jokes aside, I don't know. I think that's for others to judge. Helping Diego at some point a little bit. I don't know. No, thank you. I don't know. I'm not sure I'm in a position to answer a question like this. To others, I would just encourage to work what they find interesting and what they believe is important, and to use and to give credit to what others have done before, and try to elevate their own contribution through their own work, and that's gonna, be good. So I'm not sure what to answer to this question. It's
Okay.
Caught me a little guard.
Well, on that note, I think we're out of time. So thank you to the presenters, and thank you to the attendees for the questions. And I hope everyone has a pleasant rest of the day.
Thank you very much for organizing this. It was great fun.
Thank you, everyone.
Yes.
Yeah, it was really great presentations. Thank you.
Thanks, guys. Thanks for having us.
Bye. Bye.
Diego, for
Bye-bye.